Welcome, welcome back to this channel. This is Unfiltered Forex, me Clement, and in this video, we'll be talking about derivatives. I'm sure you know some of them. First, these are derivatives of price. Derivative, of course, comes from the word derive. These are different forms of price of one underlying asset. They are contracts. There's oil. This is an example. Underlying assets, oil, and then there's the oil price. So you can see there's a clear line between oil and the oil price. Oil as a commodity and oil price, and then there are oil price derivatives. They are forward contracts, futures contracts, CFDs. These are contracts for difference and options. These are not the only derivatives that exist, they're just the most common. There are other forms of derivatives, but they mostly originate from these four, or rather from just two of them, forward contracts and CFDs. Anyway, you're going to understand that in a bit. Uses of derivatives. So we first need to understand why derivatives exist in the first place. Hedging, risk management. You're going to understand this in the next example. Then speculation, gambling. So this is where people risk money they don't have to get money they don't need. So that's gambling. Speculation, they are used to just make a profit, and they are also used for risk management. In my view, derivatives are financial weapons of mass destruction. This is Warren Buffett. He said that in one of the letter to shareholders of Berkshire. Yep, we have seen in the past where financial derivatives, they did cause some financial turmoil. It has happened. Example, this is how derivatives came into existence. So derivatives for hedging. These are oil producers or the miners, the people who do the drilling, the exploration, and then there are oil refineries. So oil producers, these are the sellers. They sell oil to oil refineries. So these guys are the buyers. Oil price is very unstable, as I am sure you already know, or you might have seen the oil charts in the second slide, or the third slide rather. Oil price is very unstable. You don't know what it's going to be in the next 3 months. So oil refineries, they are working on a budget. So these price fluctuations are not very good when you are working on a budget. They want price stability. They want to plan for how much oil they're going to buy in the next month, and for them to do that, they have to budget and they have to make sure that the oil price remains kind of stable for them to be able to work with the same budget now 3 months from now. What are they going to do? They're going to make a deal with the oil producers. This deal is in the form of a contract. They're going to make a contract with the oil producers, the refinery guys. So this contract is to buy oil at a later date for the current price. These guys are budgeting for the money they have now. Probably oil that they're going to buy 3 months from now. This is January. So oil they're going to buy in March, they are making that deal now. Or in some cases, even 6 months ahead, it's possible. Oil they're going to buy, oil that they are going to buy in July or June, they are making that deal now. They're setting the price now. So since they're working on a budget, they're going to approach the oil producers and say they want to buy a certain amount of oil on this date for this price, the current price now. So this contract for buying something at a later date is called a forward contract. Yep, and just like that, we have a derivative of price. This is how derivatives of price came to be, the forward contracts. These are like the first ones. Yeah, let's move on. Futures contracts. Now this is from forward contracts, a legal agreement to buy or sell a particular commodity, asset, or security at a predetermined price at a specified time in the future. Futures contracts are standardized for quality and quantity to facilitate trading on a futures exchange. In simple terms, A futures contract is the tradable and regulated version of a forward contract. Yeah, futures, the difference between futures and forward contract is that the futures contract is traded on an exchange and it's regulated and it's standardized and it's available for trading even for people people outside the producers and buyers and sellers situation, the producers and the what do you call them, people in the supply chain. So let's move on. CFDs. What are CFDs? Contracts for difference. The simplest form of derivatives. This is the simplest, and it's used for gambling. Oh, sorry, it's used for speculation. If you approach someone who does this as a day job, they wouldn't like the word gambling, even if that's what it mostly is. CFDs are used for speculation. You either make a profit or a loss determined by the difference between your entry and exit price. So, unlike futures and forward contracts, CFDs are mainly used for speculation because if for the sake of risk management, you cannot go for CFDs, you will go for futures or the forward contracts or options, like we will see in the next example. So, you either make a profit or a loss determined by the difference between your entry and exit price. Common in day trading since it's OTC. OTC means over the counter. Orders aren't usually passed onto the markets since there is no actual delivery of the underlying asset. So demand of CFDs, these orders aren't usually passed onto the market since it's mostly over the counter, right? It's mostly over the counter and it's just gambling. That's the general idea. Investing doesn't usually this kind of the CFDs aren't usually for hedging, they aren't usually for risk management, they are mostly for speculation, making a small profits intraday. Yeah, CFDs are good for that because it's over the counter, so it's less complicated and less less hassle. The common trading forex traders do, trading the euro versus the US dollar, trading um commodities like gold and oil, those are contract for differences. Yeah, those are CFDs. Let's move on. Options. An option is a contract giving the buyer the right but not the obligation to buy or sell the underlying asset at a specific price on or before a certain date. Simple definition. Just like futures, but in this case, the holder is not obligated to buy or sell the asset. So the difference between, as you have seen, started from forward contracts. Forward contracts were between like two companies, the ones producing the raw material and the one buying the raw materials, and then we came to futures. Futures now exist on an exchange and they are regulated, and then now we have come to options. In futures and forward contracts, the deal has to be closed. Like if you agreed to buy something at that price, you have to buy that thing at that price on that date specified in the contract. But in options, the holder is not obligated to buy or sell the asset. You can ditch the position if you are at a loss, right? Let's say you had agreed, let's go back to the oil example. Let's say you had agreed to buy oil for $70 per barrel, and then oil now is $60 per barrel. You see, you are at a loss of $10, so you decide to ditch the contract as possible in the case of options, and we'll explain why in a few. Example: strike price. This is a chart showing the oil price and time. This is the strike price, call option, put option. So these are the options. Yeah, when we talk about option, there are two options: call and put. Call is call an asset to you. Put is put an asset away from you. That's the origin of these terms. And Call option is the kind of option you buy when you are expecting the underlying asset price to go up. A put option is the option you buy when you expect the underlying asset price to fall. To buy an option, you have to pay a premium. A premium is I'll explain that in a few. A call option will become more valuable as the underlying security rises in price. Put option gains value as the underlying asset price falls. So yeah, call put that's the difference, and those are the two options. The strike price is the price at which the option is exercised. So if you buy an option today, that is the strike price, and you will have to pay a premium. Yep, premium. Remember, we talked about this in the previous slide. Just like futures, but in this case, the holder is not obligated to buy or sell the asset. Why? If you ditch your position, you will of course avoid incurring the extra loss that was supposed to come by the depreciation that came with your position. Alright, so if you ditch your position, you are giving away the premium, and that's the much you can lose. So you can see in this case, options are like futures, they are like forward contracts, but they are very different, kind of different from CFDs, because these options can be used for risk management, they can be used for hedging. I'll not go deep into the details. The premium paid to buy the option is the maximum amount of money you can lose on the expiration date, because options, futures, forward contracts, they all have expiry dates except for CFDs. On the expiration date, if your option is not in the money, it will expire worthless. No extra loss will be incurred. Your position will just disappear. Alright? If you had an option on a stock, and then let's say you had a call option on a stock, and then because the option is supposed to become more valuable as this underlying security, the stock rises in price, and if it happens to fall, yet you had bought a call option, that means your position will have depreciated, means you will be at a loss, out of the money, and therefore your option will expire worthless, and you will only lose the premium, yeah, which is the premium you paid to buy the option. That's the much you will lose. So I think that's it. I've explained the basics of how options work. Strike price, call option, put option, and then there's the expiry dates. I'm sure you know. I have explained that clearly from futures. Futures, forward contracts, options, they have expiry dates. They do not last forever, because this is a contract for a later date. That's why they have expiry date. But for CFDs, contract for difference is just the difference in price at whichever point in time. And that's it. For any more questions, you can leave them in the comments, and the end. Have a good day.